That's the volatility extension right there. Any options that were traded into the close, they start making money for those guys if it goes above here. And they start making money for the puts if it goes below here. It makes money on the straddle if it goes above here or below here on the straddle. So when we see this collection of money, it doesn't mean they're going to sell here. It means that they're asking the question, what should I be doing here? Are they going to hedge it? Are they going to buy it to hedge the calls? Are they going to buy it to hedge the puts? That's their decision at that point, isn't it? That's their decision at those points. Those are the price of the calls and the puts, absolutely. So if you bought an out, not the straddle calls puts, the out of the money. So we're looking at a strangle there, Rab. So a lot of people ask me about an option strategy, and I'm not an options trader. But if I was an options trader, if one of the easiest strategies that I would trade, you know, if I was sitting doing nothing and I just wanted to generate income every day and I wanted to hedge and I had time to hedge, the trade that I would do is I would sell the options, out of the money options on the calls and the puts to generate some cash, and then basically do nothing unless my strikes were getting put under pressure. So how do you do that as far as a trade is concerned? Well, it's very, very straightforward. This is what we talked about the other day when we talked about this $13 that we were able to pick up. Remember, that's $113. So that's $113 per position. So that 53 cents is that call option at 414s. That 60 cents is that put option at 406s, 407, sorry, right? 406s. So if the price doesn't go to either of these two levels, the call expires worthless and the put expires worthless. So you get to collect the entire $13, $113 on one position. Trade 5 of those positions, you're making $500. And you've got a very wide range. And that wide range is defined by the dealers. The dealers defining that range for you, aren't they? So what the hell happened in here? You collected 35 cents on the 411 calls. Okay, so the 411 calls, you collected 35 cents. The puts that you collected here was at the 405 puts. And when the price traded up to the 411s, your decision now is to make sure you hedge that exposure. If it goes above, you hedge it. And if it starts to come back inside, you close it out. If it goes back above, you hedge it. And obviously the idea is you've got to try and hold on to the 35 cent premium and the 42 cent premium. You've got to hold on to those premiums. So you hedge it if it goes straight above, or what some people do is they say, okay, I've made 35 cents on this. So technically I don't have to hedge this unless it goes well above. So that was the 411 calls, right? So unless it goes 411.20s, 411.30s. So for example, at that point there, now that call premium's also been used. So if I don't buy the gap between these two prices, then of course I make nothing on the calls, but I still get to keep the 42 cents. You understand? I still get to keep the 42 cents here. So some people use this as a little area to try and think about things. So what they're going to do in here is they're going to buy if it goes above that area, and they'll close out the position for a loss of 35 cents if it goes below that position. And that just wipes out the 35 cent premium that you got in the calls, but it gives you an area rather than a single price line in the sand to buy above and then sell below and buy above and then sell below and all those kind of things. What I prefer to do in that type of situation would be to make an analysis like we always do about whether this level is going to be bid or offered using volatility tools, using some of the other clues that we have in the market space. Yeah? So we check the volatility narrative. We try and figure out whether the volatility is bullish, whether the volatility is bearish in these areas. And when the price came up into that area, you can see we got a very big rip coming in here. A very big rip coming in here. Now, obviously, it's up to us to make an analysis of what that means. It's up to us to make a decision about what it means in terms of calendar spreads and the like. At first, it seems as if you should. This is the calendar spread. Okay, so this is the contango backwardation. So obviously, when you see the contango backwardation, the first time it trades here, I think that's a good defended level. The second time it trades there, I think it's a good defended level. But by the time that the price starts to crack into this area, I do not want to be in that position. I want to hedge that position. I want to hedge that upside at that stage. So when you hedge that position on the upside there, you can see obviously you've collected 35 cents, but if you've traded this level of 411s, right? You've given away maybe 30 cents of that money. If you've got a bad price, you've maybe given away 25 cents or 20 cents of that money. You've still got 15 cents of the money. Plus, remember, you've got the 42 cents on the put that simply is now so far out the money, it's worthless. So you still get to collect 50 cents. 50 cents doesn't sound like much. It's $50, 5 positions. You get to collect $250. Alrighty. Alrighty, that's okay. I'll take that any day of the week. Not a bad outcome, right? Not a bad outcome considering the day before you collected all $113 per position. Well, today, of course, the strike prices that we're using are the 411s and the 416s. So you can recognize the 411s and 416s. You can already recognize the dealers had a very strong case to supply into this area, yeah? A very strong case to supply into this area. Now, I'm not sure that they've got a strong case to defend this at the present moment, right? So you're probably expecting this perhaps to get a little bit pressed here, judging by the way that the pricing of the contango backwardation is starting to work against you here. So I'm not sure that they've got the ammo just yet to defend into this. Now, they've got some ammo. I'm not saying they haven't got some ammo, but in the short term, I would like to see a little bit more ammo coming in for them to really mount a strong defense against this. So I wouldn't be too slow in hedging. Now, obviously, it's up to you how you hedge any type of position. Remember, you don't have to do anything if you've done what I'm talking about here. If you're sitting away down here, you don't have to make a decision until that price. You don't have to make a decision until that price. That's a different trade. You're in a different trade from the dealer. You're way out of the money on these trades. So your idea is to let that expire, because obviously you're taking advantage of the massive theta decay in those areas, right? So obviously if you can get that massive theta decay working for you, that's the whole point about selling there to the money puts and calls. They decay pretty quickly in that last little period until the point is zero, right? Until the point is that they're at zero. But until that point, you're still under risk. These have unlimited risk to the upside and unlimited risk to the downside. These are very risky positions, but they're so far out the money that you've got time to react to that risk if you need to. A good idea on these types of trades is to have a fixed sell stop order in here and a fixed buy stop order here, so that if for whatever reason you forget you're in a position, if it goes through that level, then of course you could end up getting that hedge in place and your unlimited position to the upside is no longer unlimited. You've got positions to cover that hedge. Generally, as a rule, I would agree, Ab. I mean, you're collecting pennies, but think about those pennies. $500 a day, 5 days a week, 100 grand a year. It's not a bad income, is it? It's not a bad income for a full-time job. But if you are just leaving them set, you're not going to make that money, because some days it's going to be skewed off on one side or other, and you could potentially lose, like you said, a fortune on those. But if you're actively hedging, that steamroller is actually not against you, is it? You're always able to take advantage of the ability to hedge those positions. So you've got that in your favor, remember. So we're looking at short-term interest rates just now. We're seeing the opportunity just now to possibly work some short sells on short-term rates. So how are we going to deal with this when there's absorption coming in on the sell side? So they're selling down into a heavy short sell. Well, it can't be a buy trade on an absorption, can it? It can't be a buy trade in there. So you're following that trade down with a buy stop order for a lean, aren't you? So you're not getting taken into that selling pressure. You're not getting fed into that as a buy limit order, because this might be the driver here. And with so many delta buyers, sellers coming in, then obviously all you're doing is you're feeding that buy stop order in behind the marketplace, aren't you? Should be relatively easy and straightforward to recognize that as an opportunity. But obviously the executions that you're going to do is very, very important. So we've got value to buy this, but we can also recognize that there is heavy selling coming in. Heavy selling coming in. So because of that, I can't try and buy this with a limit order. So what you're going to do is you're going to try and buy it with a stop order against a lean once you're ready to do business, aren't you? When you're ready to do business, you're going to buy it with a lean. Once you've seen what you want to be seeing, you're going to take it as a lean trade and then get into the deal. There's no reason why you can't buy in here or even in here or even in here if that absorption's in place, because if this is absorption here, it's exhaustion up here. So the idea is that they'll always want to take the stops out anyway. So it doesn't matter if we buy quite high up in the angle here. The higher up, the higher the probability that we're going to run the prior highs, of course. So we don't lose on that type of trade by being a little bit more concerned about that price of execution. If we go too low, we might come in too hard into that selling pressure, and we might not be able to get positioned properly on the right trade at the right price. So again, execution against the right setup. That's what's important, isn't it? Execution against the right setup.